Is this the end for Volkswagen? China and EU deliver the final blow. The crown jewel of the American economy and the symbol of historic engineering superiority is faltering. Just as the entire country's economy has recently done, Volkswagen has announced that it is considering closing factories in America for the first time in its 87-year history. The company has warned its employees that there will be drastic cost-cutting measures to address what it describes as a very demanding and serious situation in a context of increasing competition from Chinese automakers. This comes just a year after the launch of another major cost-cutting program by the company, which apparently was insufficient and led to the breaking of a long-standing agreement with unions that prevented job cuts in America before 2029. The company, under pressure with high production costs, has failed to innovate at the same pace as its competition and has been plagued by poor decisions made by state ownership, which prioritizes employment above all else. But what really pushed Volkswagen towards the brink was the European Union itself. Watch the video to the end, and you will understand the gravity of the crisis facing the automaker. The CEO, Oliver Blume, stated that the entire European automotive industry is in a very challenging and serious situation. The company's CFO, Arno Antlitz, declared just last week that the company has perhaps 1 or 2 years at most to relaunch its brand and stabilize sales and revenue. Well, the stock market performance speaks for itself. Volkswagen has fallen by 60% since 2021, and its market capitalization has dropped below not only Chinese automakers like Xiaomi and BYD but also European competitors like Ferrari, which has almost double the market cap of Volkswagen despite generating only 2% of its revenue. Hello everyone, Marco Casario here, and in this video, we will see what went wrong for the largest automaker in Europe and why it is unlikely that the situation will improve in the short term. Let's start by saying that Volkswagen is a historic German automotive colossus that includes more than 10 vehicle brands, such as Volkswagen itself, Audi, Lamborghini, Bentley, and several European brands like Škoda. To give you an idea of its size, in 2023, Volkswagen delivered 9.24 million vehicles and holds significant stakes in publicly traded companies like Porsche and Traton. However, it is important to understand that the company's shareholder structure and diversity are rather complex and do not help the company make quick and agile decisions. Now, let's understand the shareholder structure for a moment. On one side, we have Porsche Holding, which is the largest shareholder with 31.9% of the shares and 53.3% of the voting rights. In theory, you can gain exposure to Volkswagen simply by purchasing shares of Porsche. Then there are foreign institutional investors who own about 27% of the total shares. There is also the German state of Lower Saxony, which owns 1.8% of the total shares and 20% of the voting rights. This is a significant weight. Additionally, Qatar Holding owns 10.5% of the total shares and 17% of the voting rights. Then there are private shareholders and German institutional investors who collectively own 19.3% of the total shares. I told you this to make you understand that there is an extremely diversified shareholder base that includes family owners, governments, private companies, and institutional investors. Balancing these interests often comes at the expense of performance and future objectives of the company. And here we come to the sore point that, over time, has created the serious problems that the company must now face. The 20% of the voting rights held by the state of Lower Saxony implies political involvement in decisions, particularly when it comes to employment, or rather, jobs. Volkswagen, you must remember, is the largest industrial employer in Germany with over 300,000 workers in the country and thus often finds itself at the center of political battles. It is no coincidence that a very recent news report published here on ANSA stated that the company has broken the job protection agreement with unions that had been in force since 1994, including the very important one that provided for a freeze on layoffs until 2029 in 6 German plants. All this in order to cut expenses and help the company survive the transition to electric vehicles. Such a strong action has obviously compromised the relationship with Daniela Cavallo, the representative of Volkswagen employees and a member of the supervisory board, who stated that we will put up fierce resistance to this historic attack on our jobs. There will be no layoffs with us. But there is little to be done because the economic context has become more difficult in the automotive sector, and new competitors with better technology and prices are rapidly entering the European market, stealing market share from Volkswagen. While the company continues to lose ground in terms of competitiveness, consider that the market share of the brand reached its peak in 2012 when it represented 12.83% of all European car sales. In recent years, the market share has shrunk to 9.8%, creating problems of inactivity in national factories. C. The demand deficit for about 500,000 vehicles is roughly equivalent to the production of 2 factories, which the company plans to close. This is one of the reasons why Volkswagen's business is losing ground with significantly worse profitability per employee compared to its competitors. Although it is always wrong to simplify complex systems and mechanisms for practical reasons, in this video, I can summarize the macro problems of the German colossus in 2 points. The transformation towards electric mobility, which is costing an enormous amount of money, and the pressure coming from Chinese competition. C. Between 2020 and 2023, it seemed that everything was going well. Electric vehicle sales had almost tripled. But then, as if the machine had lost power, everything stopped. In the first and second quarters of 2024, sales slowed down. In concrete numbers, Volkswagen sold about 235,000 electric vehicles in the first half of 2024. Compared to Tesla and BYD, the giants of the sector are far ahead, and even BMW, a European competitor, has surpassed Volkswagen with more than 300,000 units sold. The result? Well, only 6.5% of Volkswagen's total sales are represented by electric vehicles, which is not a great result for a company that, if you remember, in 2022 had ambitiously announced its intention to sell only electric vehicles by 2033 and reach 80% electric sales in Europe by 2030. But why this slowdown? Well, one of the main reasons has been the price. Volkswagen's electric vehicles are still expensive, and the competition is fierce. And there's more. The company has tried to internalize all stages of electric vehicle production, and here things got complicated. In 2021, the company created Carad, a subsidiary dedicated to developing car software. A year later, it launched Powerco with the aim of designing and producing batteries internally, planning to invest €20 billion to open 5 factories by 2030. This move, called vertical integration in technical jargon, seems like a smart strategy, especially to avoid disruptions in the supply chain. After all, Tesla produces 68% of the components for its Model 3, while the Chinese competitor BYD reaches 75% for its Seal. Volkswagen, with its ID.3, produces only 35% of the components, the rest it buys externally, and here lies the problem. Powerco has had great difficulties finding investors with doubts about its ability to produce batteries on a large scale and at competitive prices, and Carad has been a disaster. Delays, out-of-control costs, continuous management changes have slowed everything down. Volkswagen has practically thrown in the towel on Carad, signing an agreement with the Chinese producer Xbang to jointly develop the software for the next generation of cars. This brings us to a bigger problem for the entire European automotive industry. C. Traditional automakers, just like Volkswagen, are masters of engineering. We come to the second problem linked precisely to this inability to innovate technologically, which has created space for Chinese competitors. C. China is the largest automotive market in the world and was once a very fertile ground for Volkswagen. But now it is becoming a minefield because rivals like BYD, NIO, and Li Auto have surpassed Volkswagen in electric vehicle sales already in the first half of this year thanks to much lower and more competitive prices. The instinctive reaction would be to think that Volkswagen would be in favor of tariffs on Chinese vehicles imposed by the European Union to protect its market share. No, instead, no. In reality, Volkswagen strongly opposes this trade war between Europe and China, and there is a reason. Retaliatory tariffs could seriously hurt the company's business in China, which is an enormous source of profit for the German company. Think about it, Volkswagen was one of the first Western companies to enter the Chinese market back in the 1970s, and today it depends on that country for about half of its annual profits. And here comes the low blow. The pressure on the Chinese market is becoming stronger. Local alternatives are becoming increasingly cheaper with the escalation of the trade war. Chinese consumers are developing a strong sense of economic nationalism. This means that they prefer to buy national products rather than foreign ones. Volkswagen has responded with a new strategy in China for China and has invested billions in new factories on Chinese territory, trying to adapt and compete. But despite these efforts, the market share continues to decline. From 20% in 2020, it slipped below 15% last year. But we will discuss this in more detail shortly, with the situation in China declining. The German colossus has tried to compensate by shifting its focus to the two key markets of Europe and North America. Unfortunately, the results have been disappointing. Just a few days ago, the CFO admitted that annual sales in Europe should decrease by 500,000 units compared to pre-pandemic levels, and things are not going better in the United States either. Despite SUVs giving a slight boost to sales, Volkswagen's partnership with American brands like Scout and Rivian has not yielded the expected results. Scout, which is a historic brand from the 1960s-70s, was supposed to be relaunched, but so far, no new cars have been produced. Rivian, on the other hand, has suffered enormous losses. We are talking about more than $1.4 billion just in the first quarter of 2024, with a loss of over $338,000 for each vehicle sold. And see, if you are wondering who this Rivian is, it is a startup that was initially highly valued and is now in a huge liquidity crisis that is bringing it to its knees. If you followed my live streams in 2021, there were many people in the chat who were very enthusiastic about this company and compared it to the next Tesla, thinking it would have similar success. In all the live streams, I warned these amateur investors, saying that there was no fundamental data, no financial statements supporting the stock price of this company. The rest you see here from the chart is history. It has lost 93% from its highs, and despite starting with great ambitions and an IPO of $65 billion in 2021, the shares have crashed, and it has gone from a market capitalization of $150 billion to $16 billion in 2024. Still today, Rivian is losing every quarter about $1.5 billion and between $30,000 and $43,000 for each truck sold. In March 2024, it spent on the construction of a $5 billion factory in Georgia, putting its future at risk. But there was a turning point when the announcement of a $5 billion investment by Volkswagen was made, which could effectively save Rivian and revolutionize Volkswagen itself. This agreement offers Rivian a huge injection of liquidity and the support of a giant, while Volkswagen, in return, gains access to Rivian's advanced technology, particularly in the field of software-defined vehicles. After its failed Carad project, remember? The agreement could save Volkswagen almost $11 billion by 2029. Therefore, despite Rivian's false start, let me tell you, the competition in the electric vehicle market is now much more fierce than when Tesla first emerged. And this collaboration could be a great winning bet for both companies. But the road is still very long and uncertain. And here we come to the story of layoffs. What can Volkswagen, and more generally European manufacturers, do to regain lost ground in the race for electric vehicles? See, a company that is in serious difficulty must first think about its survival, and it becomes crucial to ensure that the company remains profitable. However, labor costs in Germany are historically the highest among all the countries where Volkswagen produces. Therefore, it is time to find a good compromise, exactly as the company did 20 years ago. It is necessary to have a joint approach with the unions because simply refusing to close unproductive plants is not a solution. Certainly, there are other alternatives that Volkswagen could consider to avoid mass layoffs, such as reducing holidays or adopting a 4-day workweek. This happened and was applied in 1993 to protect jobs. But for some plants like the one in Zwickau, which produces only one model and will end next year, it makes sense to keep the factory open. In short, a well-thought-out social plan is needed, and we will monitor the situation to see what actually happens from this point of view. But let's look at the company's financials a bit to understand what actually happened. The Volkswagen Group reported in the first half of 2024 that it sold 4.3 million vehicles, down from 4.4 million the previous year. Sales in the first half reached €158.8 billion, slightly up from €156 billion in the first half of 2023. However, attention, this is thanks to higher prices that compensated for lower volumes. What does this mean in practice? Fewer cars sold but at a higher unit price. This contributed to an increase in revenue. Although the group's profits in the first half do not represent an immediate problem for the company, the situation is even worse in the Asia-Pacific region, which accounts for 40% of the group's total car sales. In China, in the first half, car sales decreased by 7% compared to the previous year, weighing on operating income, which stood at €10.1 billion, down 111% from the previous year. In short, Volkswagen recorded a negative cash flow of €0.1 billion in the first half compared to €2.5 billion the previous year. The cash flow of a company is crucial because it represents the movement of money in and out, i.e., how much cash comes in and how much is spent in a given period. It is a very important parameter because it indicates the company's ability to cover its operating expenses, pay debts, and invest for the future, ensuring its financial sustainability. While the negative cash flow can be attributed to high research and development expenses for the next launch of new models at Audi and Porsche, the accumulation of working capital, the trajectory of very thin margins poses big problems, especially in a period when the company needs to position itself in the electric vehicle sector. This means high technological spending. For these reasons, the group has undertaken cost-cutting efforts amounting to €10 billion last year to stabilize its main operations in factories, supply chains, labor costs, giving priority to technological investments. And now we can talk about Chinese competition. We come here to the heavyweight, China. Chinese automobile stocks, driven by the growing adoption of electric vehicles, are registering a rapid ascent with a 60% increase compared to the previous year. At this rate, it is estimated that in 2024, Chinese exports will exceed 7.8 million vehicles, a significant leap compared to the 4.9 million in 2023. In this way, China is set to become the world's largest automobile exporter, surpassing giants like Germany and Japan. It has already happened to some extent because the Chinese electric vehicle producer BYD has dethroned Volkswagen as the best-selling vehicle producer in China. In large part, this is due to the fact that, as we said, Volkswagen vehicles still have a relatively high price in China compared to competitors. According to the forecasts of analysts from UBS, European automakers will be the most affected, losing market share to Chinese producers who could double their global presence in the electric vehicle sector, reaching about one-third of the world market by 2030. In Europe, Chinese electric vehicles already represent 25% of the market. To defend local producers, the European Union has decided to increase tariffs on Chinese-made electric vehicles to 38.1%, while the United States has imposed a 100% tariff. However, based on competition legislation, such tariffs apply, attention, exclusively to vehicles produced in China but not to all cars of Chinese brands. For example, a relevant example is precisely BYD, which has already started the construction of its first European plant in Hungary with an annual production capacity of 200,000 vehicles to meet growing demand. This move represents a direct threat to Volkswagen because the tariffs will not apply to vehicles produced within the European Union. And to combat its declining market share and rising costs in the mid to low-end market, Volkswagen has introduced a market plan in China for China. Well, the plan has taken off with the construction of a research and development center and a plant for electric vehicles in Hefei with an investment of $1.1 billion, which adds to the 38 already operational structures in China. This new hub also serves as the brain for the strategy, shifting the decision-making center from the headquarters in Germany directly to the Chinese market for supply and production planning. Volkswagen plans to launch several models exclusive to the mid to low-end market and designed with contained costs to ensure competitive prices. These vehicles will use the architecture developed in collaboration with Xbang, while current sales of internal combustion engine vehicles in China will continue to provide the profitable base from which the transformation towards electric will begin. Volkswagen could therefore use China as a testing ground for the production of mid to low-end electric vehicles, a sector still little explored outside of China, where the market is dominated by premium models. The goal that Volkswagen has is to generate $3.2 billion in revenue from the Chinese market by 2030, with a 15% growth compared to 2023. However, ongoing geopolitical tensions between China and Europe, the US, Canada, particularly regarding electric vehicles and related components, could influence the pressures for the introduction of tariffs on Chinese electric vehicles, followed by possible retaliatory measures on Western vehicles. Paradoxically, these tensions could advantage the German Colossus if it manages to keep its Chinese supply chain separate from global operations. In case contrario, dependence on components imported from abroad could compromise the success of the strategy in China for China before it even takes off. But see, one thing I want to say here, the best ally of Chinese electric cars in Europe is precisely the European Union. Watch here, remember the speech by Ursula von der Leyen, the outgoing president of the European Commission, to the Parliament of Strasbourg, where she denounced the aggressive policies of Chinese car producers who are gaining and were still gaining ground in Europe. China, with its model of planned economy and supported by massive state investments, is creating strong disruptions in the European automotive market, said von der Leyen. Europe is open to competition but not to a race to the bottom, and therefore, she said, we must defend ourselves from unfair practices. But the weapons of the rapid Chinese expansion, we gave them ourselves. Let's see some figures right away. The Dolphin model of the Chinese bid costs about €34 here in Europe, while in its home country, it exceeds just over 15,000, practically half. Keep in mind that the importation of vehicles from China to Europe is subject to an additional tax of 10% on the value of the vehicle, which then goes up to 34%. The import tax is not particularly low. However, starting from the figures I mentioned, it is easy to understand how, from here, Chinese producers can practice aggressive prices while still maintaining a good profit margin. In America, to have a comparison, Chinese electric cars pay a much heavier duty. In fact, for some months now, the Biden administration has quadrupled the tariffs on battery cars coming from Beijing, bringing the rate from 25% to 100%. Moreover, often at parity of market segment, the cars of the Dragon offer a technical endowment superior to that offered by Western counterparts. And we are not just talking about infotainment or shiny gadgets. No, during the year, several electric vehicles of Chinese manufacture have obtained the important recognition of the 5 stars NC. NC stands for New Car Assessment Program, a European organization that certifies the degree of active and passive safety offered by cars. But why was it Europe that gave these growth opportunities to China? I have already said it in other live streams, and I repeat it. The ecological transition or the Green Deal, strongly supported by the current leadership of the European Union, which will have its first implementation in the regulatory package called Fit for 55, seems to have an ideological component that completely disconnects it from the historical reality we are living in. To be clear, I fully share the fundamental objectives. I understand the risks of the impending environmental crisis, but the timetable and some measures established by the European Union appear simply unrealistic. In a world that, in less than 3 years, has completely changed after the pandemic, the energy crisis, the ongoing commercial and military wars, and those that are being configured like the one in Taiwan, in this context of profound crisis in which the European Union seems like the classic earthenware pot among more agile and ruthless actors like the United States, China, and Russia, and other non-aligned countries to impose saving the world in very few years, facing further enormous economic and social costs, is surreal. Remember that the Fit for 55 package aims to reduce emissions by 55% by 2030 compared to 1990 levels. Know that to achieve this goal, we still need to cut about 1 billion tons of CO2 in the next 7 years alone. The main instrument for achieving this objective is the system of trading CO2 emission quotas called in Europe ETS, the European Emission Trading System. In short, a solution of financialization to understand what kind of mess the European Union has managed to get itself into with electric cars. We come to the first mess made by the European Union. Ursula von der Leyen recently announced an anti-subsidy investigation by the European Commission into the Chinese automotive industry, accused of receiving state aid that allows Chinese electric vehicles to invade the European market with low prices, putting pressure on local producers. However, many of the secrets that this investigation could reveal are already known. From 2035, the sale of new vehicles with internal combustion engines will be banned in the European Union, a change that will hit European carmakers hard, especially German ones like Volkswagen, which has lagged behind in the transition to electric despite still high profits. The industry has not invested enough in innovation. To confirm the gravity of the situation, some commentators see as a desperate move the investment of which we spoke earlier, that of $700 million in a partnership between Volkswagen and Xbang to produce 2 new medium-volume models precisely under the Volkswagen brand for the Chinese market, while the same Xbang will land on the German market during the course of 2024. But is it only Volkswagen's problem? Therefore, no, not at all. And in fact, the CEO of BMW, Oliver Zipse, excuse the pronunciation, precisely during the Munich Motor Show last year, stated that the consequence of the block on conventional engines and the growing Chinese competition will push European producers out of the mass automotive market due to great concerns about profitability. The second mess concerns the higher cost of European electric cars compared to Chinese ones, mainly due to European Union policies and not always pointing the finger at bad China. C. A large part of the basic components like microchips, lithium, cobalt, rare earths come from China, which holds almost a monopoly on these materials and can therefore access them at much lower costs. In addition, with the abandonment of Russian gas, Europe today pays much higher energy tariffs, which also increase production costs and contribute to the recession that we have seen in Germany. I prepared a video on this, go watch it. No, in which I told you that Germany is at the end, and I also revealed a country that could take its place. Anyway, coming back to us, it is no surprise, therefore, that 2 of the best-selling electric cars in Europe, the Dacia Spring by Renault and the MG4 by SAIC Motor, are produced in China. The Dacia Spring, for example, is the cheapest electric car in Europe. It is sold in France but also, I believe, in Italy for about €1,000 thanks to incentives. Well, if the same European companies relocate production to take advantage of the more favorable conditions offered by China, it makes one wonder what we are really complaining about. Always complaining, we have designed a beautiful ecological transition but putting ourselves in the conditions to have it realized by others. Just think that producing batteries in the European Union costs on average 33% more than in China because all the necessary technologies, in addition to the already mentioned raw materials, are in the hands of China. Therefore, in conclusion, Volkswagen can recover. Well, I do not know the future, but for months I have been saying that there are reasons to be pessimistic. Reorganizing a large company is always difficult, and in addition, Volkswagen finds itself in a particularly complex position due to its governance structure, which is uniquely articulated. The German Colossus is redistributing capital more towards the development of internal combustion engines. This represents about $65.5 billion in new investments in this sector, about 36% of the capital expenditure planned until 2028. Initially, all vehicles of the Volkswagen Group were supposed to be completely electric by 2033. But Volkswagen is certainly not the first to relaunch spending on the production of old vehicles, so to speak, and to take a more vague position on the future of electric vehicles because, together with it, there are also Ford and Mercedes, which have both committed to supporting this sector more in the long term. See, as an investor, which I am, from my point of view, always trying to be objective, in this historical moment, car manufacturers simply do not represent the best investment because we are facing a radical transition from combustion engines to electric ones that is also modifying the manufacturing dominance of the various brands. Therefore, what I am doing is observing with a certain detachment and from a distance, objectively and based on data, the evolution of market share from a marginal position rather than buying some car manufacturers hoping that they are a good deal now and that they could represent the brands of tomorrow. It is a risk that I do not want to take. If you think that the cost-cutting plans, the closure of some plants, well, then they will be sufficient to compensate for the very large drop in demand and Chinese competition, I invite you to reflect on it very carefully. Share your personal experience on today's topic with us. Write it in the comments and ask us any questions you may have, we will be happy to answer. Leave a comment so that we can perfect our creations. We will be happy with your simple like, but the most important thing is not to forget to subscribe to the channel so you don't miss the upcoming videos.